Hello, my name is Andrew. I've been a quantitative developer and a risk manager for over 15 years, working at some of the world's largest and most successful investment banks and hedge funds. Now, this is somewhat of a soft relaunch of this channel. Several months back, I posted a few videos, but the world started burning. I didn't have the time nor the energy to keep up, and I didn't have the audience to entertain either. However, I returned today in hopes of bringing some of the best of what I've learned on the street to you, to break down some of the most important topics that are important to your portfolio, but are really insufficiently discussed on YouTube and other platforms when it comes to learning how to invest yourself. Now, my goal is to help bring some of these quote-unquote smart money tips and the kinds of tricks that I employed at hedge funds that would allow you to better understand the risk of your portfolio. Over the coming weeks, I hope to cover topics such as risk management, risk measurement, trade sizing, stress testing, and portfolio construction. I hope to follow a little bit of a different route with my channel than many of the others that I see and you may subscribe to here on YouTube. I'm not going to be hawking an online course. I have no private Discord channel and no Patreon for you to subscribe to. Perhaps, if you care for my content, you'll subscribe, maybe like the video. Unfortunately, that's really the best way to get exposure, but I'm not going to waste too much time begging you to do that on every episode. I have a little bit more respect for your time than to reiterate this over and over again. Now, hell, I probably won't even talk much about specific stocks. To be perfectly honest, there's a lot of opportunity for an ethical lapse that I don't want to be accused of or responsible for. What I will talk about is how to think about your investments, to build a framework for assessing and approaching your portfolio. And unlike some that are out there, this is a topic I've really studied and come to master over the years. I've obtained my master's degree in quantitative finance. I've studied for and obtained my CFA charter. My career has been dedicated to quantitative development, quantitative risk management, and executing well on these kinds of topics. This is always going to be somewhat of a shoestring operation, though. As you can see, I have no set, and as you could probably tell, I have no editing. I'm going to be pulling this together after a long day on the trading desk every week or so, but I hope you find it informative and helpful. So, to give a little bit of a teaser, somewhat of a final thought for now, let's just talk very, very briefly on what is the topic of risk management. Now, in practice, this means that you structure your trades and your portfolio in such a way that you limit the downside. There are a lot of different tools at your disposal to do this, some of which you may understand at different levels. Now, there's the obvious, buying or shorting individual stocks. You could take that a step further by using index funds or alternatively inverse index funds to give yourself exposure for or against different investments or sectors. You can use options and other derivatives to gain exposure or to hedge risk as well. At the end of the day, it's really placing a level of insurance on your investments to ensure that you don't realize some excess loss. You can use these tools to really highly customize your portfolio in ways that just simply going long or short some shares of stock wouldn't allow for individually. You can really think of any investment as a package of different risks and exposures. So let's take an example to show what I mean about this. Let's take everyone's favorite high-flying company, Tesla. Now, Tesla has many different components to the riskiness of the stock. Now, some of the biggest may come from secular trends and sector exposures because Tesla does not easily slot itself into a singular industry or sector. It could be thought of as an automobile company. They like to view themselves as an information technology company. And then there's, of course, the clean energy component and the component that seeks to profit off of things like clean energy credits. Now, you might look at that and say, I want exposure to most, but not all of these risk components. Let's say I think that the US automobile market is in a downward secular trend. I love Tesla. I think Tesla is going to outperform the vast majority of US automakers. I strongly prefer them to Ford or GM, let's say. But I still think that the market, that sector as a whole is going to be a drag on Tesla. So you can think about, how do I mitigate that risk? You could go long Tesla, buy the shares, and you can mitigate some of that risk by shorting an index fund that tracks the automobile sector. This would allow you to effectively remove the automobile risk from your Tesla investment. Now, how to structure these trades and other approaches to that same exact problem we could talk about in later weeks. But the important thing to keep in mind is that you can add to or remove factors of risk from your portfolio at will with a number of different financial instruments that you as a retail investor have access to. You also need to keep in mind, though, there is no such thing as a free lunch in finance. Well, there's one that we'll talk about later, but this is not a free lunch. You cannot remove a major risk factor from one of your investment selections without giving something up. And in this case, you are limiting your potential upside from Tesla by removing that automobile exposure. Because what if US automobiles set on fire in upcoming months? But risk management is a field of balancing your losses against gains to ensure that you're compensated for taking risks in the market. Because not all risks are compensated. For example, if you have a company that you think individually is pretty risky, they are taking a very risky business approach, you might call that an idiosyncratic risk. And idiosyncratic risks are rarely properly compensated for because other investors and the market assume that you can effectively diversify away that risk. So that is considered to be an unrewarded risk. So that's all I have for now. I wanted to just take a little bit of time to introduce myself and introduce the kind of concepts I'll be talking about here. I will leave you with one obligatory demand. If you do not have one, please, please, please open a brokerage account and make sure it's funded. We're in a very volatile time in the market right now, both because there's uncertainty of the ongoing pandemic, there's the uncertainty of the US elections, and both of these things are going to continue to create lots of opportunities in the market. And opportunity favors the prepared, plain and simple. And the best way you can be prepared is to have that dry powder, to have cash sitting in your account. Because the last thing you want to do is to have to liquidate an investment in order to seize a new opportunity. Because when you're forced to liquidate, that may cause you to realize some losses that otherwise you might not need to. In this market also, patience is the most important virtue, and you need to kind of have that dry powder and a lot of patience as you wait for the right opportunities to arise. Now, if you're asking for a recommendation of who to use, I have used a number of brokers over the years. The broker that I use today, one is TD Ameritrade. They've been around for a very long time. I will say they are undergoing a merger right now with Chuck Schwab. So we'll see how that plays out. The one that I use the most for my more active trading is Webull. It is an app-based commission-free broker that's available on iOS and Android. They have a top-class desktop application as well for, I believe, Windows, Mac, and Linux. And, at the end of the day, out of all the commission-free brokers out there, and I've used many of them, I was a proponent for Robinhood. Now I'm a strong vote against. I think Webull really balances the user-friendliness of their tools, the reliability of their platform, and just the general flexibility and powerfulness of their tool set for researching your own investments. I'll put a link in the description that if you use Webull will grant you 2 free shares in your account. They could be anything from Ford at $7 to Google at, as of today, somewhere around $1,500 a share. Full disclosure that I will get a free share too if you sign up using my link, but that is at no cost to you and no obligation to you to use that as well. So that's all for tonight. Thank you for listening. Good luck out there and happy hunting.